Artificial intelligence, AI, you're probably sick and tired of hearing those words. But just like 25 years ago, this was only the start of something new. Back then was the internet, now it's AI, and it's moving even faster than before. In this video, we're going to talk about 5 companies I believe are buys and hold for a long time. Those won't be small caps, those will be names that you know very well and will do extremely well in the future as well. Now first, let's talk about the actual market size, the artificial intelligence market size. You can see here a couple of categories. So there is the total, computer vision, AI robotics, machine learning, autonomous and sensor technology, natural language processing. That's the green one. Of course, the biggest chunk right now and for the years ahead is going to be machine learning. Then you've got autonomous and sensor technology. After that, you've got computer vision and then AI robotics, or by 2030, it's going to be natural language processing and then AI robotics. So right now it says here that in 2024, the artificial intelligence market is projected to reach $305.9 billion. And by 2030, that should be closer to $740 billion, resulting in an annual growth rate of 15.83%. Now, of course, since this is a market and industry that is changing rapidly, these numbers will of course change throughout the years. And so it is very important to pick solid companies, winners that will win no matter what happens in the future. So before we jump into that, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So I'll show you here already the 5 picks so that if you're not interested anymore, those are the 5 companies we're going to talk about in this video. I'm going to go over a couple of valuation metrics and analyst projections for the coming years. So we've got Nvidia, Microsoft, Amazon, Google Alphabet, and Palantir. Of course, there are plenty of other companies out there that will definitely benefit from artificial intelligence, advancements in that field, etc. But I just wanted to put those 5 companies in this video. Of course, do share yours down in the comment section below. So let's first start with the biggest one here probably, and that's Nvidia. Now, this screen right now is about price to free cash flow. That's in the last 12 months. And you can see here the 1-year performance. Now, of course, you want to zoom out. Let's do 5 years. Right now, Nvidia's price to free cash flow is at 82.2 times. Yes, it is much higher than it was 5 years ago. But more recently, as you can see, as the stock price has gone up quite a lot, the metric, the valuation here, price to free cash flow, has actually come down quite a lot. Why is that? That's because the business itself has been growing so fast. And the same could be said here with Amazon, which is going to be the second company we're going to talk about. But right now, this is Nvidia, 82.2 times, which is the most expensive out of this list. If we look at forward PE, Nvidia sits at 36.5 times, and it's the same story there. If you look at the blue line here, despite the stock going up and up and up, the blue line has actually come down dramatically in the last couple of months. Yes, more recently, the stock has gone up a lot starting this year, whereas the business has not seen the same growth rates as before. But still, for a company that is growing as fast as Nvidia, that is dominating in what they're doing, 36.5 times is not the most expensive thing you're going to see in the market. With regards to a forward PE, the most expensive one in the list is Palantir. But with Palantir, of course, we also know this is just the start of them being a profitable company. I expect that number also to drop quite a lot, unless of course the stock runs ahead of itself. Looking at what the analysts are expecting from Nvidia in the coming fiscal years, tremendous growth, fiscal year 2025, sales growth of 82.2% year over year, and EPS growth of 91% year over year. Moving into fiscal 26 and 27, sales growth and EPS are going to go down by quite a lot, but still close to 20% growth top and bottom lines year over year for both fiscal years, and that's just the expectations right now. Of course, with the recent announcement during the GTC event, those numbers can change, those numbers can go to the upside or to the downside. Remains to be seen what happens, but currently you're buying a company that is growing extremely fast, becoming way more profitable than ever before, valuation is still quite okay. Going back to stock number 2 here, and that's Amazon. Amazon currently trades, has a forward PE of 42.5 times. Of course, Amazon more recently also you've seen their cash flow operations, free cash flow increase by quite a lot. Margins have becoming much better, and so the company has become more and more profitable, and I do expect that trend to continue this year and for the years ahead. So right now, Amazon forward PE 42.5 times. And if we look at price to free cash flow, that's the orange line. As I said before, there was a big period where there was no free cash flow, there were no earnings for Amazon. But more recently, well, that completely changed. The company is becoming more and more efficient right now. Price to free cash flow in the last 12 months, 57.7 times. I expect that number to come down by quite a lot. And if we look at what the analysts are expecting for Amazon in the coming fiscal years, sales growth of around 10-11% or so for the coming 3 fiscal years, but everything changes when you look at the bottom line. It's becoming way more profitable for fiscal year 2024, 45.15% year-over-year growth, then another 28%, close to 29% for the next 2 fiscal years. Now, more recently, this news came out. Amazon invests an additional $2.75 billion in AI startup Anthropic. They've already been investing in that company for quite a while. This is another move by Amazon to secure their lead when it comes to, well, some of the leads they have when it comes to AI, when it comes to AWS. And they even say here, as part of the tie-up, Anthropic has also agreed to use Amazon Web Services data center to power some of its operations and to use Amazon's custom-built computer chips. Anthropic has also committed to using chips from Alphabet's incorporated Google, another close partner, which is the next company I want to touch on. So Google, as I've been saying for the last couple of weeks, Google, Alphabet, it's one of the, if not the cheapest big tech company you can buy right now. Price to free cash flow sits at 26.9 times. Yes, it was lower back at the end of 2022. Well, back then, well, everything was pretty cheap, but still, right now, 26.9 times for a company that is growing and is still very profitable. My opinion is a no-brainer. If we look at their forward PE, it's still a joke, 22.1 times. Again, it's really quite remarkable how undervalued or how misvalued Alphabet is right now, just because it had some flops with regards to Gemini, which again, the headlines, all of that didn't help the company, and rightfully so. It's their fault, their mistakes. They should have done it better. But the core business is still extremely profitable. And in my opinion, it is my opinion, I've been using ChatGPT, Gemini, and Grok, and in my opinion, Gemini is just so much better. You get access to Google, you have great answers. Yes, all of those chatbots, all of those LLMs make mistakes. Plus, you can even ask them to connect it to Google Docs, so that's already quite a plus. And with Alphabet, since they're doing quite a lot of buybacks, the last 5 years, shares outstanding have come down by 10.58%. And if we look at what the analysts are expecting from Alphabet in the coming fiscal years, this will probably explain a little bit why it gets a lower valuation than the other big tech companies. It's because, well, growth is not expected to be as high as the others. If you look at the sales growth, it's approximately 10-11% for the coming fiscal years, year-over-year growth. Then if you look at EPS, it's closer to 15-16%. So nowhere near what we've seen before. But in my opinion, that will change in the coming quarters, where suddenly the company will make a couple of announcements or will show in the quarterly results that, look, we're still one of the leaders, if not the bigger leader in the AI industry. Our core business is still extremely profitable, so maybe you should pay attention to us a little bit more. Moving on to company number 4, and that's Palantir. So Palantir currently trades at 75.2 times when we look at forward PE. So definitely the most expensive of the bunch here. But like I said, this company just became profitable. So to only look at PE, in my opinion, is a big mistake. And that's not just for Palantir, by the way. That's for every other company out there. If you're looking for tech companies, software companies, growth companies, only looking at a PE and making your conclusion just by looking at a high PE and saying, oh, this company is super expensive, I'm not going to buy it, you're probably going to miss out on a lot of opportunities. A PE is just one of the points to look at. And to be looking at a software company just at the PE, especially the E right now, is a big mistake. Because we know that software companies have high margins, around 80% or so. So what you want is to see sales increase. To look at price to sales might be a better indication, or to look at sales growth might definitely be a better indication, because the more revenue that comes in, the more that E will eventually grow. Of course, depending on the expenses. More on that in just a second. Then if we look at price to free cash flow in the last 12 months, here as well, Palantir, the most expensive one, 77.8 times. They've been generating free cash flow for quite a while. And like I said, as revenue continues to accelerate and accelerate, at least that's the anticipation, that's the expectations right now. We were a bit disappointed a year and a half or so ago, but now with the effect of AIP bootcamps, AIP now as well, more on that in another video, revenue should accelerate, free cash flow should grow as well. If we look at what the analysts are expecting, they're currently expecting only because I do expect it to be a bit more, for fiscal year 24, 25, and 26, around 20% growth year over year. Then if we look at EPS for fiscal year 2024, 30.6% year over year growth, and then 20% year over year growth for the coming 2 fiscal years, which by the way, is not that bad at all. But of course, to catch up to valuation, you would like to see that revenue sales continue to accelerate to justify the current valuation, especially to justify the current, let's say, hype around everything that they've been doing. So far, execution has been great. And then the last company is Microsoft, which in my opinion is probably the most dominant player today, because of all the investment that they've made, because of all the right moves that they are been making for the last couple of years. I mean, since Satya Nadella came in, really transformed the whole business, whether it's regards to Azure or more recently the partnerships, the investments in OpenAI and in the other companies as well. More on that in a second. Right now, price to free cash flow, Microsoft sits at 46.2 times. If we look at forward PE, that sits at 34.4 times. So again, not that expensive for a company that is so well positioned. Largest company right now, surpassed Apple, market cap $3.11 trillion. And here in the last 5 years, shares outstanding have been reduced by 3.15%, plus you get a 0.71% dividend yield. And now what are the analysts expecting for Microsoft? So for the coming fiscal years, sales growth of around 15% year over year for each and every year. EPS growth for 2024 around 19%, and then closer to 14 to 17% year-over-year growth for the next 2 fiscal years. Now, more recently, Amazon has made another big move. So they went to Inflection AI, they made a partnership there, licensing deal of around $625 million or so, and they poached, I believe, the biggest talent of that company. I believe they poached their Mustafa Suleyman, founder and former CEO, who now leads Microsoft Consumer AI division. So mix that with their investment in OpenAI. I mean, it's pretty clear that Microsoft are becoming the number one or close to the number one player in everything AI, whether it's B2B or B2C, Microsoft is there. Now, of course, like I said, these are just 5 companies. You can include all the other companies there as well. Meta, Oracle, Adobe, Tesla, you name it. Do share your thoughts down in the comments below. Those are certainly pretty good picks to have in your portfolio, basically buy and hold positions for long-term investors. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.